Did you know that about 46% of TSP investors have their investments in the target date fund, also known as the Lifecycle Fund? And if you think the C Fund is crushing it this year, think again. Right now, deep into 2025, the so called set it and forget it Lifecycle Funds are quietly outperforming the C Fund or the S&P 500 of the TSP world. How is that possible? Well, it's a story of global markets and diversification. So is it time to put money in the life cycle fund or keep investing in the individual TSP funds? But first things first, let's get on the same page. And I want to show you exactly what I'm looking at. If you go to my website at firesightchat.com/resources, you will see my TSP price tracker. And I built this tool so anyone can see how the funds are performing without any of the usual clutter. And I retired from the Air Force after 20 years, and I still continue to track my TSP and help people like veterans on a daily basis. And I'm recording this on the weekend, so I just want to wear more of a relaxing shirt for this video. Now, when you pull that up, you'll see the individual funds on the left, C, S, I, F, and G funds. And on the right side, you will see the full lineup of life cycle or L funds. Now, I have to give the standard disclaimer here. And depending on when you're watching this video, the market could have zigged or zagged. So these exact numbers will be different. But the principle we're talking about today, the why behind the numbers, stays the same. As I'm recording this, 8 full months into 2025, the picture is fascinating. The life cycle funds have outperformed the C fund, the S fund, the F fund, and of course the G fund. The only individual fund that's beating everyone, the king of the hill for 2025 so far, is the I fund, the international fund. And that is the key to this whole puzzle. Now, let's just run down the line here, and you can see this on the tracker. And take the L2040 as an example, a fund for people maybe in your age group or getting close. It's up a very solid 10.04%. Then you move to the L2045, and that number climbs to 10.5%. The L2050 is sitting even prettier at 10.99%, or we'll just call that 11%. Now, remember, all of this is happening while the C fund, our good old S&P 500, is at 9.44% return. But the story doesn't stop there. Once you get to the funds for the younger crowd, the L2055, 2060, and 2065, they're all sailing along at a fantastic 12.46% gain for the year so far. Even the brand new L2070 is at a 12.47% gain. The takeaway is simple. From the more conservative growth funds all the way to the most aggressive ones, every single L fund is leaving the C fund in the rear view mirror right now. It's a clean sweep across the board. And frankly, that's pretty remarkable to see. So this brings us to the $1,000,000 question. Is this normal? And have the life cycle funds always been the secret sauce, quietly beating out the individual stock funds? I'll be blunt. No, not even close. This year is an anomaly, and understanding why it is an anomaly is crucial for your long-term strategy. Let's look at a history, and you can see this right on the TSP website. If we rewind to just last year, 2024, it was a completely different story. The C fund returned a massive 24.96%, and the S fund pulled in 16.93%. They absolutely crushed the L funds. And the L2040, for example, only did 12.85%. Why the huge difference? Well, look at the I fund in 2024 because it underperformed with a 4.27% return. Since the L funds hold a big chunk of the I fund, it acted like an anchor dragging down their overall performance while the C and S funds were soaring. Okay, but what about 2023? That was a monster year all around. The L funds look great, with returns over 23% on average for the more aggressive ones. But you have to look under the hood. That performance was because all the stock funds did incredibly well. The C fund was up over 26%, the S fund was up over 25%, and the I fund put up a solid 18%. When everything is firing on all cylinders, the L funds are going to have a great year, but they still slightly trailed the pure C and S fund performance. They did their job, but they did not beat the market. Now, this is where it gets really interesting. Let's look at a bear market and go back to 2022, a year most of us would rather forget. And it was brutal. The C fund lost 18%. The S fund got absolutely hammered, losing a painful 26%. But look at the L funds. The L2045, for instance, lost about 17%. It still lost money, yes, but it lost less than the C fund and way less than the S fund. And big reason for that was the I fund, which also lost money, but it its loss was smaller at negative 14%. The G fund in the L fund mix also helped cushion that blow. So in a down year, that diversification really helped to slow down the bleeding a little bit. So if we're looking for a time the L funds actually beat the C fund in a positive market, when was the last time that happened before this year? You would have to get in a time machine and go all the way back to 2007. Way back then, the L2030 fund posted a 7.14% return. The C fund that year, a more modest return of 5.54%. Now, why did the L fund pull ahead back in 2007? It was because the I fund had a fantastic year, returning over 11.43%, and which was double what the C fund did. You see the pattern here? The life cycle funds tend to outperform the C fund in years when the I fund outperforms the C fund. And in 2025, the I fund is not just outperforming, it's absolutely dominating. As of right now, at the time of recording this video, the I fund is up a staggering 20.4%. It's leaving both the C fund with 9.4% and the S fund with 4.1% in the dust. That massive performance from the international portion of the L funds, it's what's lifting the entire L fund portfolio and pushing it past the C fund's return. Now, to be fair, the last time the I fund technically outperformed the C fund was in the ugly bear market of 2022 when it lost less money. But if you're looking for the last positive year, it did so before 2025, and you have to go back to 2017. And that year, the I fund returned a fantastic 25.4%, while the C fund returned 21.8%. But here's the thing, even with the I fund winning that race, the L funds still did not beat the C fund that year. Why? It all comes down to the recipe, the asset allocation. Back then, the allocation to the I fund in the L fund mix was not quite large enough to make up the difference. But the TSP has adjusted those allocations over time, giving more weight to international stocks in the modern L funds. So let's pop the hood again open and let's see how this actually works with real numbers. We'll use the L2050 fund as our example, a popular choice for folks planning to retire around that time. And according to the TSP's data for July 2025, the L2050 fund is broken down like this: about 42% in the C fund, 11% in the S fund, 29% in the I fund, and the remaining 18% split between the G and F funds. Now, let's run a hypothetical situation to make this crystal clear. Imagine you have exactly $100,000 in your 2050 fund at the start of the year. Now, let's say the C fund gives you a solid 10% return by the end of 2025. And let's say the S fund lags a little bit with a 5% return, and the I fund crushes it with a 20% return. And for the sake of simplicity, we'll say the G and the F funds together just chug along and give you a 2% return. So out of your total $100,000, since you've got $42,000 in the C fund, that's 42% of your portfolio with a 10% return. That part grows by $4,200, bringing your C fund balance to $46,200. Next, the S fund. Since you have $11,000 allocated there, a 5% return adds $550. Your S fund slice is now worth $11,550. Now, for the star player, the I fund, since you have $29,000 invested internationally, a massive 20% return on that is an increase of $5,800. Your I fund slice balloons to $34,800. Finally, the boring but stable part. Since you have $18,000 in the combined G and F funds, a 2% return adds a modest $360. That part is now worth $18,360. So what's the grand total? You started with $100,000 and ended with $110,910. That means your overall rate of return for the year in the 2050 fund was 10.91%. Do you see what happened? In this scenario, your L fund returned 10.91%, which is slightly better than the C fund's 10% return, and it trounced the S fund's 5% return. It achieved this specifically because of the nearly 29% allocation to the high-flying I fund. This simply means that I fund's stellar performance was enough to lift the entire average. And if the I fund had only say 15%, the math would flip and the L fund would underperform the C fund. It's that sensitive. So should everyone pile into the life cycle funds? Not necessarily. It's all about knowing what kind of investor you are. The L funds are brilliantly designed for one type of person, the invest and forget investor. This is for those who don't want to track the markets, who do not want to worry about rebalancing their portfolio every quarter, who just want to put their money in, have it professionally managed, and automatically grow more conservative as they approach retirement. It's an elegant, simple, and effective solution for millions of people. Now, here's a mistake I see people make all the time. They think they can outsmart the system by mixing and matching. They will put 50% of their money in the L2050 fund and then put another 25% in the C fund and 25% in the S fund on the side. This makes absolutely no sense. The L fund is already a carefully crafted recipe with specific percentages of C, S, I, G, and F fund. When you add more C and S funds on top of it, you're throwing that formula completely out of whack. And you may be taking on more risk without realizing it by overweighting yourself in US stocks or bonds and defeating the entire purpose of the L fund's built-in diversification. At that point, you might as well just choose individual funds on your own. So here's the bottom line. You really have two smart choices. A, you decide you want to be a hands-on investor. You do the research, you decide on your own risk tolerance, and you build your own portfolio using the individual CSIG and F funds. You are responsible for rebalancing it yourself. And B, you decide you don't want that headache. You choose the L fund that most closely matches your retirement timeline, and you let the L fund handle the allocation and rebalancing it for you. Both are valid strategies. The mistake is trying to do both at the same time. So when you look at 2025 so far, it's a textbook example of why diversification matters. The only reason life cycle funds are beating the C fund this year is that they've got a big chunk in the I fund, and the I fund is on fire right now. That strength is more than making up for the fact that the US stock funds are not quite as hot. Now, let's be real, this is not a norm. In most years, when the C fund is having a strong run, it usually leaves the L funds in the dust. But it's a good reminder that market leadership changes, especially when you look beyond the US. And that's the whole point of L funds. They are built to spread out the risk and smooth out the ride. If you're the hands off type, they're doing exactly what they're supposed to do. And for the rest of us, it's a front row seat to how market dynamics really work. And let me know in the comment section down below what you're doing with your TSP right now. Are you sticking to your life cycle fund, or are you sticking to your individual funds? And this has been another piece of the video, and I hope you got a lot out of it.